Hey there, curious minds. You've just tuned in to NewsDecoded, your daily habit-forming dose of clarity in a world overflowing with noise. If you crave fearless facts, sharp analysis, and honest conversation that respects your intelligence, you're in the right place. Before we dive deep, take a second to lean on that subscribe button, tap the thumbs up if you value independent journalism, and share your own lived reality in the comments. Your engagement isn't a vanity metric for us. It's the lifeblood that keeps this community thriving and keeps the algorithms from burying stories that matter. All set? Let's decode. Tomorrow, July 16, 2025, the Bureau of Labor Statistics drops its latest Consumer Price Index report at 8:30 a.m. Eastern. Markets are bracing for a number that still feels uncomfortably hot. Futures on the 10-year and 30-year Treasury notes have already drifted lower, a sign that large investors expect sticky inflation to force higher interest rates. Meanwhile, the White House economic team has fanned out across television studios, insisting everyday prices are on a gentle glide path. One advisor, economist Kevin Hassett, even touted falling import prices as proof that patriotic shopping habits, and by extension tariff policies, are paying off. That claim sounds nice, but it bumps into what so many of you see when you open a grocery delivery app or stand in the produce aisle.
Let's illustrate with a single item: tomatoes. For nearly 3 decades, a suspension agreement between the United States and Mexico kept a lid on punitive duties. That changed on May the 31st, when a new 20.9% tariff took effect. Wholesale quotes compiled by the Federal Reserve Bank of St. Louis show field-grown tomatoes averaging $1.70 per pound before the duty. Analysts at Arizona State University estimate a 10% retail bump once transport chains and grocers bake in their margins. If your local supermarket charged $2.29 a pound in June, expect something closer to $2.50 as early as next week. Maybe that is still affordable for you. Maybe it squeezes an already tight food budget. Either way, no televised soundbite overrides the number on the scale at checkout.
Tariffs rarely stay confined to one crop. The administration has also floated 30% duties on European wine, cheese, and durum wheat pasta, products worth roughly $10 billion a year to exporters in Italy, France, and Spain. Europe's main agricultural federation warns that an 80% collapse in Italian wine shipments would follow, calling the proposal a death blow. Closer to home, think through the ripple. A beloved Chianti that once landed stateside at $14 may reprice to $18 or vanish altogether. Will a California Zin remain at $16 out of goodwill, or creep toward $17.50 because competitors are suddenly scarce? Markets abhor a vacuum less than they adore an opportunity. The political logic behind tariffs, at least the way advisors such as Mark, our stand-in name for a prominent television host, justify them, is that they protect domestic producers and eventually spur local investment.
But history says protection can also dull competitive pressure and invite price coordination.
In plain language, if import costs jump and demand remains, U.S. producers sometimes lift their own price tags rather than cut you a patriotic deal. That is not cynicism, it's Econ 101 incentives. Now you might ask, isn't inflation finally cooling compared with 2022's brutal peak? Yes and no. Energy's contribution is down sharply from the days of $120 crude. Goods like used cars have rolled over after pandemic shortages eased. Yet core services, housing, insurance, medical care, and education continue to climb at an annualized pace above 4%. Housing alone represents a third of the CPI basket. Until rent growth truly stalls, families will keep feeling squeezed even if gasoline sits at $3 a gallon. Let's broaden the lens from price tags to paychecks. The most recent monthly jobs report showed a net gain of 142,000 positions, solid on paper.
But dig deeper, and the manufacturing sector shed 28,000, while full-time work overall fell for a third straight month. More people report stringing together multiple part-time gigs to approximate one livable wage.
If tariffs raise input costs and retailers pass them on, households without strong wage growth face a nasty arithmetic problem. Still, the tariff debate is only one strand in the larger economic tangle. Another headline sucking up oxygen this week is the explosive growth of politically branded cryptocurrencies.
Former President Donald Trump launched a memecoin last quarter that has hoovered up $52 million in fresh capital, according to new filings. Exchanges rushed to list it. Speculators rushed to chase it. Tech entrepreneur Justin Sun publicly pledged another $100 million buy. Supporters talk about, digital freedom. Detractors see a speculative bubble that transfers real dollars from retail buyers to the early insiders who mint the coins.
On Capitol Hill, Senator Cynthia Lummis told host Mark, "Yes, we're keeping all our broadcast interviewer names consistent, that bipartisan momentum is building for a bill to regulate stablecoins and head off a central bank digital currency." She framed it as overdue maturation. Skeptics counter that new rules could end up written by lobbyists to bless behaviors that enriched a handful of well-connected players at the expense of taxpayers who eventually backstop banking crises.
Whether you cheer crypto or cringe, here's what matters. Speculative surges often coincide with or precede periods of real economy stress. In the late 1920s, it was call loan margin buying. In the late 1990s, it was .com IPOs. In 2021, it was meme stocks and Doge. Why?
When wages lag and necessities become pricier, some people roll the dice on get-rich-quick plays to plug the gap. Meanwhile, the federal government shoulders larger deficits. This fiscal year's shortfall already tops $1.3 trillion and must auction more Treasury bonds. Bond investors demand higher yields as compensation for inflation risk and ballooning supply, pushing mortgage rates north of 7%. Higher borrowing costs then circle back to consumers through pricier credit card APRs and student loan refinances. It's a feedback loop. You may be thinking, that's a lot of doom. Where's the agency for ordinary citizens? Well, it starts with knowledge. Keep personal price diaries on key staples, like milk, eggs, produce, and cleaning supplies. If you spot, say, a 15% tomato jump, adjust your meal plans. Maybe use canned San Marzanos for sauce, swap out fresh salsa for corn relish, or just lean into seasonal zucchini. If wine tariffs start to bite, explore domestic vineyards in upstate New York, Virginia, or Washington state. These often use minimal additives and might have hovered below your radar. And you can pressure local stores to stock those alternatives by asking for them explicitly. Second, stay vocal. Share your first-hand data with neighbors, city officials, and yes, with federal representatives. Policy rhetoric moves when enough voters convert anecdotes into measurable patterns. Remember, the CPI itself draws on tens of thousands of price quotes from stores nationwide. Grassroots transparency forces accountability in a way polished podium statements just can't. Third, diversify your savings. If your retirement portfolio is 90% large-cap domestic equities, consider adding some modest foreign-developed exposure or inflation-protected securities. When Washington's fiscal outlook is, murky, a broader spread of assets can really buffer shocks, but, and this is crucial, resist anyone urging you to pour emergency funds into a celebrity-backed coin without understanding custody risk, volatility, or tax treatment. If something insists it's a guaranteed moonshot, just run. Fourth, keep an eye on tomorrow's CPI for clues about the Federal Reserve's trajectory. The consensus among Wall Street economists is a 0.4% monthly rise in headline CPI and 0.3% in core. A hotter-than-expected print could sink equities briefly and pull mortgage rates even higher. A cooler number might give equities a bid, but it won't erase tariff-driven spikes in specific categories. Either way, watch how markets interpret the release over several sessions, not just the knee-jerk reaction. Fifth, and this circles back to the tomato example, practice substitution and forward buying. When staples run promotions below their recent average cost, stock the pantry if shelf life permits. Rotate items to avoid waste and cushion future price shocks. It's basically the consumer-level equivalent of a diversified bond ladder. Finally, maintain perspective. The United States has endured post-war inflation cycles before. The oil shocks of the 1970s, the wage price spiral of the early 80s, the commodity spike in 2008. In each case, policy eventually righted course and real incomes recovered.
The task now is not simply to endure, but to stay informed, adapt nimbly, and participate in shaping the rules that govern trade and finance.
Let's recap the action items you control. Track your personal basket and call out discrepancies. Favor competition, domestic or foreign, that truly lowers your cost of living. Evaluate investment fads with sober math, not celebrity gloss. Use your vote and your voice when policy seems detached from street-level reality. You've stayed with us across Treasury yields, tariff tables, grocery aisles, and blockchain hype. A whirlwind, but exactly the interdisciplinary terrain where real-world economics lives. If this reporting helped peel back a few layers of spin, keep us in your daily rotation. Smash that like so the algorithm knows substance still matters. Tell us in the comments what tomatoes, wine, or even school supplies cost where you live and how you're adapting. Most of all, share the feed so more people can escape the echo chamber and join a data-driven conversation. Your support, whether a quick tap on subscribe, a thoughtful comment, or sharing this video over dinner, makes News Decoded possible. It fuels investigative trips to state produce auctions, deep dives into bond market microstructure, and frank interviews that cut through talking point fog. Until tomorrow's CPI numbers hit the wire, stay curious, stay critical, and take good care of yourselves and one another.